Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. We're talking about the market outlook and best strategies for the second half of 2021. Matt, welcome back. Thanks for joining us.
Yeah, thank you for having me back on.
So the first half has been pretty good for stocks. I would say not as good as last year, though. But the three major indexes are up between 11% and 15% year to date. But we have seen a lot of volatility and these constant rotations in and out of value stocks or in and out of tech stocks. And I think the volatility is mainly because of these fears of inflation, even though the Fed continues to assure that inflation is most likely transitory and they are not going to withdraw their accommodation anytime soon. So let's start with your thoughts on the recent market performance.
Well, I think, over the last few sessions, probably the last 2 weeks or so, we have seen a stalling out of this sort of idea of a reflation rally where cyclicals, started to underperform more secular growth stocks. This coincided with a couple different variables that had a pretty significant impact. You had a really strong CPI print. You had a more hawkish dot plot view, and then some hawkish commentary that came out after it from really non-voting Fed members, which I think is just important to remember because they obviously have a say, but in terms of actual vote and on Fed policy, it's a bit different. Now, because of some of those factors, trades were taken down. Namely short bets on U.S. Treasuries, and that had a cascading effect on the cyclical rate-sensitive exposures, such as value in banks. More specifically, bank stocks. If you look at the financial sector, their RSI, so a technical measure of relative strength, fell below 30 and went to an oversold segment, even though prior to the last 2 weeks, they had been one of the top-performing segments of the U.S. equity market. And so there's a bit of this idea that the reflation trade may have been dead because the inflation view was transitory, and really reflation is different than inflation. Reflation actually speaks towards fiscal and monetary policies designed to expand output, stimulate spending, and curb the effects of economy in contraction. And we're obviously trying to navigate through this recovery to expansionary phase, and these policies are continuing to be constructive. And loose, to really increase that money supply. We still have low interest rates. There's infrastructure spending on the docket. I think, fiscal stimulus, while those large packages have already been passed, there's still going to be about 39 million households in the U.S. that are likely to receive $300 check per month starting in July for a child tax credit. So there's going to still be some fiscal policies that are going to likely increase consumer spending and the savings rate. So we feel that the reflation trade, even though it's stalled out, in the following, the last 2 weeks, it's still likely to continue. We see strong earnings growth from some of those cyclical segments like financials, materials, energy stocks. The sharp drawdown, in our view, just caused a reset and perhaps drove out some weak hands riding that reflation trade. And it's now created an opportunity to add cyclical equities as they suffered a really technically driven pullback. Because as I said, financials RSI fell below 30. Energy had a 20-point drop in just 14 days. And so our view is that the reflation trade is still on because of some of the factors going on in the economy, the supportive policy environment, and the strong earnings prospects.
Yeah, you're right. Cyclical stocks had a very strong run earlier this year. In fact, energy is still the best performing sector among all sectors. It is up more than 43% year to date. And it seems that tech has kind of regained its leadership role over the past few weeks. And technology is the best performing sector over the past month with a gain of about 7%. And it seems that investors are not much concerned about the changing antitrust enforcement, rising regulatory risks in general, and a possible change in tax policies too. And some cyclical sectors like financials and industrials, they had negative returns over the past month. And you say that this could be a good opportunity to add exposure to cyclical areas. What about technology? Do you think technology can continue to do well? Would you recommend that investors add to big tech also at this point?
So I think for technology allocations, there's a bit of a secular growth story still going on. We see this with more innovative companies that are potentially harnessing some of that transformative societal changes in our economy. So I think, more strictly traditional technology stocks, valuations are quite high on those. Earnings are obviously strong and there's a quality aspect to that as well. But I think, more specifically, tech stocks may not have the strongest performance over the next few months, just given from what you've outlined, potential regulatory changes around antitrust. But also, if we do have the infrastructure plan passed as written under the Biden guidelines, it could have an impact on taxes, and that could be a headwind to some of the firm's earnings. Our view is that technology disruption it exists beyond just the traditional classified GICS tech sector, and also exists beyond just your traditional market cap segmentation. So taking a more holistic view on sort of the rise of transformative technologies impacting our society is probably a stronger option in our view.
Very interesting. Now let's talk about the broader market. Moving on from sectors to the broader market, we saw very strong earnings growth in the first quarter and very strong GDP growth too. And we know that second quarter figures are likely to be even stronger than that. And that is thanks mainly to these rising vaccinations, opening up of economies, and the massive fiscal and monetary stimulus, they still remain in place. And you talked about the child tax credit. So what is your outlook for earnings and economic growth in the second half of the year?
Well, if we look at what Q2 2021 GDP is likely to be, it's be upwards of 10%, really, really obviously strong quarter. That's likely to be somewhat of the high watermark, but just given the low base effects of 1 year ago. But what we'll see is still strong growth in the U.S. economy. We're continuing to see upside revisions for the full 2021 earnings growth, economic growth, particularly as the economy starts to rebound. I think one of the biggest things, potentially driving this is if we look at the personal consumption expenditures for goods and services. Goods, PCE, is actually above where it was prior to the pandemic. Meanwhile, services are still well below that. And obviously, this is a very service-based economy. Consumption makes up around 70% of it. So there's still room for further improvement and to get back towards, pre-pandemic levels in some of these different macro variables. If you think about unemployment is still not back to where it was before the pandemic. So policy is still likely to be supportive of further expansionary environments. I think one thing is that when we look out on the horizon for earnings growth over the next 12 months is still likely to be higher for cyclical assets relative to traditional areas. So we say like small cap equities. Over the next 12 months, earnings expectations are for 47% growth relative to 25% for just the S&P 500. Similarly, for value stocks, that earnings growth expectation is around 30% versus just 20% for growth stocks. So value stocks have higher growth expectations, and both of the small cap and value, those growth expectations relative to their peers are coming with really constructive valuations. So the valuation difference of small caps relative to large caps is in the bottom 20-year decile. So it's in the bottom decile over the last 20 years. And the same goes for value relative to growth. So in our view, it's still supportive of this cyclical environment, this recovery. If we look at the leading economic indicators, year-over-year change, one way to gauge what part of the business cycle we are in, that indicator just flipped into expansionary. But we need a couple more data points to actually solidify that, because it's been such a sharp recovery given the low base effects and some of the macro data. But we're still navigating and managing these reopening expectations, and sort of bouncing between recovery and expansion at the same time.
Right, small cap and value, those stocks underperformed for so many years, and this year is going to be very interesting because the recovery is so sharp. Everything was shut down last year due to the pandemic, and now with vaccination, we are seeing everything opening up. People are traveling, flying, driving, buying stuff in malls, entertaining themselves. So yes, it's going to be an interesting year. Now, talking about the concerns for investors, inflation was a big concern, and we saw prices of certain commodities like lumber and copper surge. But they have rolled over in June, and the Fed continues to believe, or they are saying, that inflation is transitory. So do you think inflation will be a big concern, will continue to be a big concern for investors in the second half of 2021 too? Or it could be a growth disappointment, as there may be a slight withdrawal of the fiscal stimulus or monetary stimulus, or a change in tax policy? What is the biggest concern or risk for investors as of now?
Inflation, transitory or not, is going to be present, right, for some of the the economy, and us to be able to deal with it, in terms of higher prices at the gas stations and grocery stores. That's going to have an impact, quite notably. Now, even Powell admitted that the transitory nature of it actually somewhat surprised them. So right now, where break evens are, I think it's a bit in the price, so to speak. The expectations for inflation, there's been so much concern and consternation around that. We've obviously seen a lot of flows into tips-based ETFs, sort of positioning for this environment. I think we're still likely to see some strong inflation prints, but I think the bigger risk is around a Fed surprise around policy. Even just what we witnessed the last week, where a more hawkish dot plot view rattled markets and really created a lot of volatility. That is one of the bigger risks. And I think what we'll see is the Fed acknowledging this, because really right now they only have one monetary policy tool at their disposal, and that is forward guidance. Forward guidance can be really constructive. We see that with the dot plot view. It sort of signals to the market, like, look, at some point we'll start to normalize policy. Yet, even though those dot plots should be taken with a huge grain of salt, but there's a lot of forward guidance being given around when the tapering should be expected, because the last thing they would want to do is have a taper tantrum at this type of market recovery. So really, the big date to circle on a lot of investors' calendars will be Jackson Hole this summer, when the Fed gets together in that confab and talks about the future of monetary policy, because I think you'll get some really strong rhetoric coming out of that on where they might see policy in the fall, which, as you may or may not have seen, Powell suggested that unemployment may be stronger in the fall, and Fed President, the San Francisco Daily, suggested that tapering may start later in 2021 into 2022. So it sort of aligns with their viewpoint on the labor markets, which, again, everyone focuses on inflation, but no one's really focused on that the Fed has a dual mandate, which is also full unemployment. And unemployment, whether you look at the U3 rate or the U6 rate, is still extremely high relative to the pre-pandemic levels.
Very interesting. So what is your recommendation to investors in this market environment? How should investors position their portfolios for the second half of the year?
Well, in our view, when we started the year, we talked about balancing cyclical versus secular. And we still feel that is the same. We should be favoring cyclical segments of the U.S. economy, as well as the broader economy too. But in the U.S., that's small cap, that's value, It's bank stocks. Higher interest rates will benefit bank stocks in terms of net interest margin, as well as improving economic growth will likely lead to stronger loan demand. Earnings growth and earnings expectations are reflecting that. Earnings revisions over the last 3 months have been really strong for the financial sector, one of the strongest out of all other sectors. Similar with mining companies, the rise in input prices, the consistent sort of demand side pull on prices, but also the supply side, given what we've seen from a supply chain, has had a significant impact on earnings expectations. Earnings expectations for mining stocks in 2021 is 377%. And it sort of speaks to some of the load base effects, but also what we're seeing in terms of price growth. But I also think, overseas, there's a potential opportunity within European equities. European equities, a lot of people have sort of thrown them out because they are more cyclical. They do not have a high growth exposure, do not have a lot of technology. And right now, that cyclical exposure is likely in their benefit because the European economy is starting to rebound. It's a bit behind the U.S., so it's a bit of a catch-up play. Valuations are constructive, and economic sentiment overall is starting to really improve. So we think the investors should really favor cyclicals and Europe, and then continue to focus on that transformative technologies, because the pandemic had such a massive impact on our society and the way we operate. We're much more digitally connected as a society. There's a lot of innovations going on, whether it's around artificial intelligence, robotics, mobile payments, different innovative technologies within biotech and healthcare, and basically just the impact on the labor force. I mean, roughly by 2030, 105 million jobs in the U.S. are likely to be changed just based on how labor trends are shifting given the impact of the pandemic. So still focus on that sort of transformative technologies impacting our society.
All very interesting. Now let's talk about some of the implementation ideas for positioning the portfolio for the second half of the year. And as you mentioned that you're quite bullish on the small cap value cyclical stocks. So talk to us about some ETFs that you would recommend for which would benefit from this reopening rally and which also look attractive from valuation perspective.
Sure. So, within our range of State Street Spider ETFs, we have a couple different options for investors to consider that aligns with our overall market outlook. The way to focus on cyclicals and Europe. One is just your traditional value exposure with something like this Spider Portfolio S&P 500 Value ETF, ticker SPY-V, or within small caps with Spider Portfolio S&P 600 Small Cap ETF, SPSM. Now, there's other higher conviction options here. We talked about banks and metals. Bank stocks, we can cover that with an industry exposure like a KBE. And then also for miners, similar industry exposure with XME. And then Europe with our Spider Portfolio Europe ETF with SPEU. I think the really interesting part, though, is when we think about the idea of targeting that transformative innovation around cutting edge technologies. We feel that innovation is not confined to a specific sector. So it's not just the tech sector. It's not confined to a specific market capitalization spectrum. So it's not just large caps or small caps. It's not confined to either value or growth. So you can't just look at growth stocks. And it's definitely not confined to where you list your exchange, your stock on an exchange. So you can't just be all NASDAQ stocks from that as an example. Just one example. So we feel it's something that's really broad-based. Something like our Spider S&P Kensho New Economies Composite ETF, ticker KOMP, is something that could provide an opportunity to harness the broad-based nature of innovation, because it allocates roughly 490 securities across 22 different areas of innovation, and really sort of seeks to target the really depth and breadth of the innovation facing our society right now.
All very interesting ideas. Switching gears a little bit, I was also interested in your thoughts on meme stocks. This trend that we have seen over the past few months, though meme stocks appear to be taking a breather over the past few days. What do you think about this new trend in the market?
Well, I think it sort of speaks towards some of the risk appetite in the marketplace, and particularly around the way personal finance applications have democratized investing. They've made it, more accessible to certain parts of our society. I think largely, these are sort of, temporal bubbles in some of the stocks that are temporary, and then fueled by sort of, outsized exuberance. And our discussions with clients are just talking about going back to the basics, and should a stock really be trading at 700 times next year's earnings, and what's the rationale for the investment here. And we usually don't typically get into single stocks because we think about it more from a broad-based asset allocation perspective. So it sort of, again, just goes back towards personal finance applications, more access, liquidity in the market, and really just some irrational exuberance towards certain areas and beaten down stocks. And largely we try to stay on that path of long-term asset allocation.
Very interesting. And that's all we have time for today. Matt, thanks again for joining us.
Thank you.
So that was Matt Bartolini, Head of Research at State Street. Let's recap the ETFs that we discussed earlier. For value, he mentioned SPYV. It is the Spider Portfolio S&P 500 Value ETF. For small cap, SPSM. It is the Spider S&P 600 Small Cap ETF. For banks, KBE. It is the Spider S&P Bank ETF. And for Europe, we talked about SPEU, which is Spider Portfolio Europe ETF. And we also discussed ETFs to invest in transformative technologies. It is KOMP. It is the Spider S&P Kensho New Economies Composite ETF, quite a name. Take a symbol KOMP. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe to our show so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.